G'day, I'm Todd Lees from Latima Brokerage and welcome to another Pulse Market update. Harvest is gathering momentum and progressing slowly from the north of the grain belt in Queensland and progressing slowly down to the southern states of Victoria and South Australia. Farmers in central Queensland have been harvesting chickpeas these last 3 weeks, and receivables to date would suggest that 60 to 70% of the crop has been harvested to date, and by all accounts quality is very, very good. Given the dry spring conditions that we've experienced these last 3 months, harvest is getting away a little bit earlier than usual in northern New South Wales for fava beans and in South Australia for lentils. Bear in mind though that the bulk of these crops, for these two pulses in particular, will be harvested in November and December. Crop estimates at this point in time have chickpeas at around 400 to 500,000 tonnes, which is significantly lower than last year. Fava beans are at around 500 to 600,000 tonne, which is around about the same level, and lentils are at about 1.3 to 1.6 million tonne, which is slightly lower than last year's production. So what does this mean for prices going forward? Well, we see several key factors are going to have an influence on price direction. Number one, harvest pressure. Logically, you would think that the more tons that come onto the market, it will put a pressure on price, which therefore is potentially bearish. Two, El Nino declaration. So our government has officially declared an El Nino weather pattern event, which suggests we're going to have a hotter, drier spring and summer seasons, which should say to farmers that they need to start thinking about risk mitigation strategies in case they're unable to plant a crop and grow a crop next year due to low soil moisture conditions. An obvious strategy here for any farmer is to withhold the current stock that they have and keep it on farm, store it on farm, and keep it as a hedge, because the last thing they want to do is have to buy grain later in the year to feed stock. So potentially the El Nino situation is leading towards a bullish leaning for prices. Three, geopolitical events between trading countries can affect logistical operations and also hinder supply capabilities. And last but not least, simple supply demand dynamics. Demand plays a huge part in the pricing equation. So you as an importer probably have the best understanding of how your particular country and the market is going to have an influence on price direction over the next 12 months. Another interesting dynamic to keep an eye out for is the freight differential between container rates and bulk shipment rates. It's been moving in the right direction. That spread has been narrowing, and if that continues, we're probably more than likely to see a swing back to containers for those more traditional container markets like Egypt, Bangladesh and Pakistan, which is a good thing. So far, container rates are moving in the right price direction. Well, that's it for me for this wire. I'm planning a visit to Egypt later this month, and I look forward to catching up with many business associates and friends during this time. If you've got any questions or comments, please feel free to drop me a line. Thanks for listening, and bye for now.